On December 12, 2024, something extraordinary happened. Silver shattered $64 per ounce, breaking its inflation-adjusted 1980 peak for the first time in modern history. But this wasn't just another speculative rally. This was the inevitable result of a supply crisis that has been brewing for 5 years. A crisis so severe that it has vaporized 820 million ounces from global stockpiles since 2021. To put that in perspective, that's nearly an entire year of global mine production that has simply vanished. For the 5th consecutive year, industrial demand has completely overwhelmed what the world's mines can produce. In 2024 alone, the deficit hit a staggering 149 million ounces. Why? Well, China installed over 250 gigawatts of solar capacity. Each gigawatt consumes 300,000 ounces of silver that will never, ever return to the market. Global above-ground inventories have collapsed from 1.5 billion ounces in 2022, less than 1 billion today. At this rate, we have maybe 4 to 5 years of buffer left before the math becomes impossible. This isn't just a prediction. It's what analysts call stage 4 of the industrial commodity crisis pattern, the acceleration phase, where permanent consumption swamps finite supply and prices don't just rise, they go exponential. Today, I'm going to show you exactly how this happened. We'll look at how this same pattern played out in copper in the 2000s, why silver's unique supply situation makes it impossible to just mine more, and why major banks are now targeting $65, with some analysts even talking about $100 plus scenarios. Understanding this isn't just about silver. It's about recognizing the collision course between the global energy transition and the hard limits of our planet's resources. Every industrial commodity crisis starts the same way, a quiet setup. Between 2019 and 2021, the fundamental demand for silver was being permanently transformed, but most people were just watching the day-to-day price flickers. The smart money saw the shift, but the masses wouldn't catch on for years. The catalyst was the energy transition. The crisis truly began in 2019, but almost no one noticed. That was the year solar panel installations started growing faster than technology could reduce the amount of silver needed in each panel. Analysts were wrong. They thought efficiency gains would mean less silver. Instead, Chinese solar installations exploded, driven by subsidies and green energy mandates. Solar became the fastest-growing energy source in history. And remember, each gigawatt of solar requires about 300,000 ounces of silver for photovoltaic paste and electrical contacts. This is silver that gets consumed forever. It's not recycled. By 2020, solar was eating up 195 million ounces annually, nearly a quarter of all mined silver, locked into a single industrial use. This wasn't investment demand that could just disappear. This was permanent consumption, baked into decades-long infrastructure projects. At the same time, the electric vehicle revolution was kicking into high gear. A gas car uses about 15 to 25 grams of silver. An EV needs 25 to 50 grams, sometimes up to 79% more per vehicle. As EV production grew 13% annually, automotive silver demand climbed to 25 million ounces by 2024. And it's not just the current number, it's the trajectory. Projections show EVs could become the biggest driver of automotive silver demand by 2027. And unlike a 25-year solar panel, cars are replaced every 8 to 12 years, creating a recurring demand cycle. Then came the third driver, the digital infrastructure explosion, AI and 5G. Since the year 2000, data center power capacity has grown over 5,000%. Every server, every cell tower, every computing facility needs silver for its high-performance electrical contacts. When ChatGPT launched in late 2022, it triggered an AI infrastructure build-out that consumed shocking amounts of silver. Each AI server cluster requires far more silver than traditional computers because of the sheer power and heat they generate. This demand was almost invisible to commodity analysts focused on jewelry and coins. Stage 1 created the perfect storm, multiple exponentially growing demand sources, all hitting a wall of fixed geological supply that most investors were simply ignoring. This brings us to Stage 2, the years 2021 to 2022, when supply constraints finally became visible. This is the point where the industrial users, the people who actually need the metal to build things, start to panic. But the financial markets, they're still trading it like supply is infinite. The warning signs were there, months before it hit the mainstream news. Today, we're rediving deep into a topic that has been quietly brewing under the surface but is now impossible to ignore: the silver market. Forget what you think you know, because the game has fundamentally changed. Let's start with a reality check that became crystal clear during the recent supply chain chaos. Did you know that 70 to 80% of all silver isn't mined for silver? It's actually a byproduct. It comes from mining for other metals like copper, zinc, lead, and gold. This creates a really strange situation. Normally, when the price of something goes up, producers rush to make more of it. But with silver, it doesn't work that way. The supply is almost entirely dependent on the demand for base metals. Think about it. Miners aren't digging up rock because silver is profitable. They're chasing copper or zinc, and silver just happens to be along for the ride. So if copper demand slumps, guess what happens? silver production falls, no matter how high the price of silver goes. This is the core reason why, even as silver prices climbed from just $12 an ounce in 2022, an incredible $64 by late 2024, mine production barely budged. It stayed almost completely flat, and it gets worse. Even if we wanted to open new primary silver mines, it's not a quick fix. We're talking 10 to 15 years from finding a deposit to actually producing silver. It costs hundreds of millions of dollars. If we greenlit every single proposed silver project on the planet today, we wouldn't see that new supply hit the market until 2035 at the earliest. At the same time, we're facing another huge problem: declining ore grades. The quality of the rock being mined is getting worse. At existing mines, grades have dropped by 30 to 40% compared to just a decade ago. This means miners have to process way more rock to get the same amount of silver. That drives up costs, increases the environmental impact, and makes the whole process less efficient. Let's look at the top silver-producing countries. Mexico, the world's largest producer, only managed a tiny 2% growth in 2024. Peru, the third largest, actually saw its production decline by 1%. Chile's output fell a staggering 17%, and Australia is projecting a 12% decline for 2025. The world's biggest players are struggling just to keep up, let alone increase production. With supply so constrained, industrial users are starting to panic. They're competing fiercely for every available ounce. Inventories at the Shanghai Futures Exchange have hit multi-year lows. In London, the cost to borrow physical silver is rising, a classic sign that physical metal is getting scarce. And over at the COMEX warehouses in New York, we're seeing consistent drawdowns as big consumers demand physical delivery instead of just rolling over paper contracts. When industrial giants stop trusting the paper market and want the real thing in their hands, you know there's a serious supply problem. This isn't a temporary glitch, it's a permanent feature of the new market. This brings us to the next stage, where the big financial institutions finally woke up and smelled the coffee. By 2022, analysts confirmed that the silver market had been in a deficit for 3 years straight. With a total shortfall of over 500 million ounces, the math was becoming undeniable. Let's break it down. Annual mine production is about 820 million ounces, but industrial demand alone is now a whopping 680 million ounces. That's over 80% of all new silver being consumed by industry before anyone even thinks about jewelry, silverware, or investment coins and bars. Add in 200 million ounces for jewelry and a potential surge to 250 million ounces for investment, and you have potential demand of over 1.1 billion ounces. Even with about 190 million ounces from recycling, the total supply is only around 1.01 billion ounces. The deficit is structural. We're burning through our above-ground stockpiles, and those stockpiles are not infinite. Bank of America was the first major bank to sound the alarm. In late 2024, they raised their 12-month silver price target to $65 an ounce, citing permanent industrial demand, the inability of mines to respond, and dwindling global inventories. Soon after entering projected average prices of $55 into 2026, other institutions started talking about scenarios where silver could hit over $100 an ounce if investment demand picked up. The consensus on Wall Street is that the current price in the $60s is UNT, the end of the rally at just the beginning of a major re-rating for silver. And then came the final piece of the puzzle, the Federal Reserve's policy shift. In late 2024, the Fed started cutting interest rates. Historically, lower rates are like rocket fuel for precious metals. Why? Because the cost of holding a non-yielding asset like silver goes down. We saw this back in 2010 and 2011, when investment demand for silver exploded from 50 million to 250 million ounces in just 18 months. With the Fed now in a cutting cycle, the stage is set for a similar dynamic. So, what we have is a perfect storm. A supply that can't respond to price, declining mine quality, rapidly growing industrial demand, dwindling inventories, and now a supportive central bank policy. The byproduct reality of silver means this isn't a cycle that will correct itself. It's a structural shift that could redefine the value of silver for decades to come. The critical difference is this: the investment demand we saw back in 2010 and 2011 happened when the silver market was balanced. But today, any new investment demand is hitting a market already facing huge structural deficits. This could trigger an acute supply shortage. We are now in what I call Stage 4, acceleration and mainstream recognition. This is the phase where supply constraints can no longer be hidden. Mainstream attention starts driving even more demand into a market that's already incredibly tight. A game changer is coming. In 2025, the United States is set to officially designate silver as a critical mineral, essential to national security. This isn't just a label change, it's a fundamental shift. Silver goes from being just a precious metal to a strategic industrial commodity, just like lithium or cobalt. What does critical mineral designation mean? It means government stockpiling. It means prioritizing domestic supply chains and building strategic reserves. When governments start competing with industrial users for silver, the entire demand dynamic changes forever. Nations don't trade critical minerals, they hoard them. This move acknowledges that silver is absolutely indispensable for solar energy, 5G networks, electric vehicles, and the AI infrastructure that governments see as vital for their economic and national security. Now, let's look at China. Their 2024 solar installations blew past all projections, hitting over 250 gigawatts. Just think about that. This single sector, in a single country, consumed about 75 million ounces of silver in just 1 year. They've already surpassed their 5-year plan targets, and their long-term goals suggest this breakneck pace will continue. This is policy-locked demand. China's solar expansion is driven by government mandates and environmental targets. It will continue whether silver costs $60 or $100 an ounce. This demand is what we call price inelastic, creating sustained buying pressure that old models just can't predict. The physical market is already flashing warning signs. London silver lease rates are rising, meaning it's getting expensive to borrow physical silver. Prices in Shanghai are trading at a premium to London, a clear sign that Asian users are paying extra for immediate delivery. And while most people aren't watching, sophisticated ETFs have started accumulating silver aggressively, with some funds adding hundreds of tons in single weeks. On top of that, manufacturers are reporting they're repaying premiums of $5 to $10 over the spot price just to guarantee delivery. These are classic signs of supply chain stress right before a major shortage. This brings us to stage 5, mathematical inevitability and system breakdown, which I project for 2025 to 2027. This is where the simple math overwhelms market mechanics, and prices could move exponentially as physical scarcity finally overpowers paper markets. Here's the critical calculation. Global above-ground silver inventories have dropped from about 1.5 billion ounces in 2022 under 1 billion ounces today. With annual deficits of over 150 million ounces, the remaining stockpiles could be gone in just 4 to 5 years. But that's a straight-line projection. What happens if investment demand surges back to 2011 levels? That would add another 100 to 200 million ounces of demand each year, accelerating depletion dramatically. At that rate, stockpiles could be completely exhausted by 2027 or 2028, leaving no buffer at all. And unlike other commodities, higher silver prices won't necessarily destroy demand. Its industrial applications are largely price inelastic. Solar manufacturers will pay $100 for silver before they sacrifice efficiency with other materials. Electric vehicle producers will absorb the cost rather than compromise on performance. What about recycling? Well, it contributes about 190 million ounces a year, but it can't really scale up. Most silver is used in tiny amounts scattered across millions of products like circuit boards and medical devices. Recovering it is expensive. The huge number of solar panels installed between 2020 and 2024 won't even be ready for recycling until 2045. By then, the cumulative deficit could be over 2 billion ounces. Recycling only accounts for about 20% of the annual supply and has grown much despite higher prices, showing its limited potential. The numbers are telling a very clear story. The stage is set for a historic shift in the silver market. Industrial demand for silver is set to accelerate, not just stabilize, and 3 key factors are driving this. First, solar energy. We're still in the early days of the global energy transition. The International Energy Agency projects a staggering 400% increase in solar capacity by 2030. This could mean we'll need over 500 million ounces of silver annually just for solar panels. Second, the electric vehicle market is expanding rapidly. EVs currently make up about 15% of all car production. As we phase out traditional internal combustion engine vehicles over the next decade, the demand for silver in the automotive sector could easily triple from where it is today. And third, the AI infrastructure build-out. The computing power needed for artificial intelligence is exploding exponentially. Each new generation of AI servers demands significantly more silver for thermal management and high-speed connections. Today's consumption of over 50 million ounces could jump to more than 150 million ounces by 2028. When you add all this up, the combined industrial demand trajectories suggest we could need over 1.5 billion ounces of silver annually by 2030. Compare that to a maximum possible mine production of 900 to 950 million ounces, even with aggressive exploration. The math just doesn't add up. So, what does this mean for the price? Based on historical commodity crises and these fundamentals, a few scenarios seem possible. In a conservative scenario, we could see silver at $75 to $85 by the end of 2025. Bank of America's target of $65 seems low, given the accelerating deficit. If industrial demand keeps growing 10 to 15% annually while supply stays flat, we'll burn through inventories faster than anyone is projecting. Technical analysis shows little resistance on the way to the $75 to $80 range, as big institutions continue to buy in. Our base case scenario puts silver at $85 to $120 by mid-2026 if investment demand returns to just half of its 2011 peak. Adding about 125 million ounces annually, the yearly deficit could balloon to over 250 million ounces. At that rate, remaining stockpiles would become critically low by late 2026. This could trigger supply allocation. among industrial users and panic buying from manufacturers trying to lock in multi-year contracts. Then there's the bull case, $120 to $200, or even higher by 2027 if stockpiles hit critical levels while industrial demand keeps growing and investment money floods back in. Silver could face a supply crisis similar to what palladium saw in 2020. Back then, don't forget the government response factor. Silver's designation as a critical mineral suggests governments might start strategic stockpiling. This is a brand new source of demand that didn't exist in previous silver cycles. If major nations build up reserves like they do for oil, it could create demand for hundreds of millions of additional ounces. Governments often buy based on national security, not price, which could deplete stockpiles even faster. So, how do you position yourself for this? This isn't just a commodity trade. It's about recognizing that the global energy transition requires massive amounts of critical minerals that might not be readily available. First, consider physical silver. Owning coins and bars gives you direct exposure without counterparty risk. Yes, you need to think about storage and liquidity, but it protects you if ETF supplies get tight. The premium you pay over the spot price is like an insurance policy for guaranteed access. Next, there are silver ETFs. They offer liquid exposure and are great for tactical plays. However, ETFs are claims on physical silver that could face stress during a severe shortage. If the physical market goes into allocation, ETF shares might trade at a discount as physical premiums skyrocket. Finally, there's leverage through silver mining stocks. Miners offer amplified exposure to silver prices, but they come with their own risks like labor issues, permitting, and cost inflation. Since supply is so constrained, existing producers with low-cost operations are probably better positioned than development-stage companies. Ultimately, every industrial commodity crisis creates a massive transfer of wealth. It moves from those who ignore the supply fundamentals to those who position themselves correctly before the trend becomes mainstream news. Understanding the five-stage pattern provides a framework for recognizing when manipulated. Markets surrender to physical reality. Stage 1 and 2 are the accumulation phase for sophisticated investors who recognize fundamental changes. Stage 3 is institutional positioning as major players acknowledge supply constraints. Stage 4 is the acceleration phase as mainstream awareness drives additional demand. And Stage 5 is mathematical inevitability, where physical scarcity overwhelms paper markets. Most investors recognize commodity crises only during Stage 4 and 5, when the optimal positioning opportunities have already passed. This brings us to the core issue: industrial reality versus financial manipulation. The silver supply crisis represents the inevitable collision between infinite industrial demand and finite geological supply. For decades, financial markets operated on the assumption that higher prices would always generate additional supply. But physics and mathematics are now proving them wrong. You cannot manufacture silver for solar panels with derivative contracts. You cannot power electric vehicles with paper promises. You cannot build AI data centers with financial engineering. Industrial users need physical metal, and physical metal is disappearing faster than it can be replaced. The five-stage industrial commodity crisis pattern gives us a framework for understanding when supply fundamentals overwhelm market manipulation. Silver has already completed Stage 3 with institutional target increases and its critical mineral designation. Stage 4 acceleration is underway with $64 breakouts and serious inventory depletion. This means Stage 5, mathematical inevitability, is approaching as stockpiles decline toward exhaustion. The question isn't whether silver will reach 75, 100, or even higher levels projected by major institutions. The mathematics practically guarantee higher prices until supply and demand rebalance. The real question is whether you position yourself correctly before the masses recognize that the largest industrial metal shortage since copper in the 2000s is already underway. Understanding this pattern extends beyond just silver to every critical mineral required for the energy transition. Lithium, cobalt, nickel, rare earths, they all face similar supply constraints as infinite industrial demand collides with finite geological reality. The silver crisis is just the beginning. The pattern is clear, the mathematics are undeniable, and Stage 5 doesn't negotiate with opinions about what should happen. It simply executes what must happen when industrial reality overwhelms financial manipulation. Thanks for watching.